Hey investors, welcome back to Stoxpot, your go-to episode to unpack what's happening around various stocks, industries, and economy. It's me, Lekshman M J, and today we are diving into a topic that's been making headlines. Yes, it's India's currency, the rupee, and its recent depreciation against the US dollar. We will explore what's happening, why is it happening, how it affects you, and what might lie ahead. So whether you are a newbie or an experienced investor or just someone who is curious about the economy, this episode is for you. So having said this, let's get started. So what exactly is happening to the rupee? Over the years, the Indian rupee has been losing value compared to US dollar. For instance, back in December 2014, $1 was equal to 63.04 rupees. Now fast forward to February 2025, the rupee touched an all-time low of 87.95 against the dollar. So that's a drop of about 37% over a decade. So having said that, now let's see why is this happening. A big reason is the strength of US dollar. When Donald Trump became the 47th US president on his Make America Great Again promise, he announced tariffs on imports from countries like Canada, Mexico, and China. These policies have made investors flock to US dollar as a safe haven. So now, as more people buy dollars, its value rises globally. That is, its value rises against other currencies, including rupee. In fact, between September 2024 and Jan 2025, the rupee fell by 2.4%, while competing currencies dropped even more, up to 7%. This means the rupee is not doing too badly compared to others. Now, having said that, now let's see why should we care about this. A weaker rupee impacts everyone differently. Yes, you heard that right. It affects everyone differently. For instance, if you are planning to study or travel overseas, you will need more rupees to buy dollars. That's because each dollar now costs more rupees. In case of imports, India imports many essential items like crude oil, electronics, and gems. A weaker rupee makes these imports costlier and finally leading to higher prices for consumers. So in consumers' perspective, rising import costs can push up inflation. Imagine paying more for petrol, diesel, or imported goods. This is especially worrying for food items like edible oils and pulses, which are largely imported. And in case of businesses, companies dealing with foreign debt face challenges. And it's not just limited to companies, even governments' external debts gets affected due to this. For instance, firms with foreign currency convertible bonds must repay them in dollars. So at this point, a weaker rupee makes this repayment even more costlier. So at this juncture, let's see what policymakers are doing. The RBI, our central bank, plays a key role here. Its governor Sanjay Malhotra has stated that the RBI does not target a specific exchange rate. Instead, it intervenes only to ensure stability and prevent excessive volatility. In December 2024, the RBI reportedly sold $70 billion to defend the rupee. While this helped stabilize the currency temporarily, it also reduced India's forex reserves from $701 billion in October 2024 to $630 billion by Jan 2025. On this RBI's action, some experts argue that selling dollars tighten liquidity in the banking system, making borrowing harder for businesses and individuals. Others believe letting the rupee adjust naturally might be better in the long run. After all, defending a fixed exchange rate could deplete forex reserves quickly without solving the root problem. So to understand the rupee's future, we must look at global factors as well. The US Federal Reserve's decision on interest rates, trade policies, and capital flows will heavily influence the rupee's trajectory. For example, if Trump's tariffs spark a trade war, the US dollar could strengthen further, putting pressure on the rupee. Now domestically, India's current account deficit, that is, the gap between what we export and import, is now manageable at 1.2% of GDP. Our forex reserves, though lower, still it covers over 10 months of imports. Plus, India remains the largest recipient of remittance globally, with inflows estimated at $129 billion in FY24. These are in fact positive signs. However, inflation remains a concern. According to RBI estimates, a 5% weaker rupee increase headline inflation by 35 basis points. This could delay interest rate cuts and affect borrowers. So where is the rupee headed? Some analysts says that it may reach 89 to 90 by the year end. So remember, RBI aims to curb excessive fluctuation rather than fixing a specific rate. So in conclusion, while a weaker rupee has short-term benefits for exporters, its long-term impact depends on how well India manages inflation, forex reserves and external pressures. Thus, policymakers must strike a fine balance between intervention and letting market forces play out. So that's all for today's episode of Stoxpot. I hope you find this episode insightful. Remember, understanding the economy helps us make informed decisions in our investment journey. And if you enjoyed this episode, make sure you follow and stay tuned for more such episodes like this. Until next time, it's me Lekshman M J signing off.